Look who walked in the studio. I wasn't expecting you so soon, but Kyle Harrington apparently slept in. So Chase Wilsey, our millennial investment expert, shows up to the studio bright and early. I understand your father is right behind you.
He's coming in. Well, I guess after Kyle, I think.
You didn't drive in together, did you?
We did not.
That's
no.
good. That's good. I like to see that your dad's not taking it to work. You heard me talk about oil in the beginning, oil and gas and stuff like that. I know you guys are not day traders, but are you guys for portfolio management? Because I know you guys run a lot of money for a lot of different retirement accounts. Do you guys ever look at that sector as a commodity at all? Is that something? I mean, is it, or does it just depend? Because you can't look at the company as how much debt's on the books, because all those companies run their businesses almost the same way, right?
I mean, not necessarily. We do think oil long-term will be okay. So, I mean, as you know, we are long-term investors, and you cannot not have oil in your portfolio. So it's a piece of the puzzle then for you guys. Yeah, not necessarily just oil, but the oil companies. And we still take a look at debt to equity. Is a company's debt increasing? If it's increasing, why is it increasing? We want to make sure we're not getting these companies that are over-leveraged 3-4 times their equity, and make sure these companies can sustain these downturns.
Explain that for people who don't understand what you're talking about. When you're talking about leveraging themselves over equity, what does that mean to the average investor?
So what we're looking at is saying, what is their debt over their equity? And equity is like someone's net worth. Or it's like, let's say you go out and buy a house, and you borrow $1 million to buy a house, and the house is only worth $800,000.
Okay.
You're upside down on the house. That's not a good thing.
Same type of thing happens with companies?
Exactly. So the equity, again, is a company's net worth. And if they have more debt on their balance sheet than equity, that could be a problem.
Okay, so let's talk about it. So a market cap, for example, is the number of outstanding shares times the share price. So let's say you have 100,000 outstanding shares, which would never happen. There's hundreds of millions outstanding shares. But let's say you have 100,000 outstanding shares. It's at $1 a share. So you've got a $100,000 company. If they're leveraged to $200,000, that's when the red flag goes up, is what you're saying.
Yeah, another way to look at equity is a company's assets minus their liabilities.
Yeah, just like a balance sheet.
Exactly. You want the company's assets to exceed their liabilities.
Right.
So.
And with respect to some oil companies, do you guys only look at do you only look at the big guys like the Exxon and the Chevron, Texaco, and the Valeros, or do you ever look at the small guys too?
We actually do have a couple of smaller drillers that
oil exploration companies.
Yeah, that have been beaten down a lot and very hard over the past few years. But right now they're trading at a tangible book value of 60 cents on the dollar. So I mean that means you're paying 60 cents for the tangible assets of a company. It is just a great value.
So what you're saying is this is like a fallen angel, so to speak. What it comes down to is basically this is a company that, for example, that might be a bargain, right? It's on sale for now, for example.
Yeah, exactly.
But everything's got to make sense, right?
Yeah, I mean, Benjamin Graham, going back to the early 1920s, talked about buying companies on sale.
Right.
And these companies have very low tangible book value, so we're saying this is a great time to be buying them.
Yeah. Chase Wilsey Asset Management is with us. He is our millennial investment expert, but I'm leaning on him for some oil advice right now. You know, one of those driller companies, I'm going to step away from Chase just for 1 second and talk about Lucas Energy. I was looking at a company called Lucas Energy because we've had the CEO on. He's just an oil expert. I haven't really looked at their stock, but it's an interesting company because that's an oil exploration company that was beaten down, but suddenly because he has no debt on the books, because he's basically run his company like you'd run your house if you lost your job, right?
Yeah.
You go on a budget. It's an interesting story. Let's talk about the millennial side of stuff today because obviously you just got through a Democratic National Convention where a lot of millennials are paying a lot of attention to Hillary Clinton. There's, Donald Trump has been vilified by the millennials, which, listen, vilified by a lot of Gen Xers and Gen Yers as well. What it comes down to is the economy here in this country. Is this election going to make a difference for you? I mean, are you worried about your retirement plan now, or is this just another blip in the road for now because you're so young?
I mean, I do have my favorite when it comes to candidate, but looking long term, I mean, whether it's Hillary or Donald Trump, these businesses is really what makes America succeed, and these businesses will find the right thing to do, and long term we will be okay. So it's about finding those good quality businesses that can really prosper during any downturn, any downtimes, any problems in the economy.
But something you and I have talked about before is trust in the government. Okay, now, when you get to be my age and your dad's age, you trust but verify, okay? I would argue, and I've got daughters your age, and they don't trust anything, which and I would say they probably shouldn't. Do you trust the government? I mean, what is your gut feeling? If I say, Chase Wilsey, do you trust the government right now?
I mean, to a certain extent, I mean, you're always going to question some of the things they do, I believe, but
do millennials, do you think, overall trust the government? I mean, what's the general consensus of people in your age group?
I would say to the majority, no. And I mean, that's kind of why we've seen the rise of a candidate like Bernie Sanders, like Donald Trump, because they really speak to this rigged system, and it really creates a rise out of my generation saying, yeah, that is, they have done this and done that. Right. We need change.
Okay, so talk about change. One of the changes that I'd like to see is millennials start to invest, because I beat the drum for financial literacy for a long time. I know your dad has as well. Obviously, your career is testament to that. Millennials should be putting money away right now, even if it's $5 a day. I think you and I talked a number of times about $5 a day, $150 a month. It's not easy to do, but if you do it over the course of a long term, and if you never put any more than that in, you'd have a nice chunk of change by the time you were 65 years old. Where do you put that? Is it a Roth IRA? Is it a traditional IRA? Do I just throw it in a savings account? If I talked my daughter into calling you up and said, I got $150 a month, what should I do with it? What would you say at that point?
I mean, it is really circumstantial, but let's say you just started a new job and they're offering a 401k. Do you do Roth contributions, traditional contributions? Again, you can do that to an IRA as well. And the thing to look at here is, well, the traditional, you get a tax deduction right off the bat.
Okay.
And then with the Roth, you have to pay taxes up front, but when you pull the money out,
it's tax-free.
It's tax-free.
Now, but are millennials worried about that at this point? I mean, and can you convert, by the way, halfway through? So once you're in, you're in. Can I? So I'm 23 years old. Can I put my my $150? Let's say I put $2,000 to open up an IRA, and I want to put $150 a month away and start. And I don't have my employer's not matching my 401k. If I want to switch gears later on, can I do that, or is there a tax penalty if I do that?
Well, if you want to switch from traditional to Roth, you do have to pay some taxes on that. And I mean, the big thing we do look at is, again, do you trust the government? Because Roth IRAs.
So what you're worried about is, will this sunset provision of not having to pay taxes on my Roth IRA when I pull the money out, will that last, is what you're actually asking.
Exactly, and we see this big problem with Social Security.
Sure.
And Social Security was actually supposed to be tax-free when it first came about. Well, guess what?
Yeah.
Now it's taxed.
Right.
And we're thinking down the road, and there's actually been talk about this, the Roth IRA very well could be taxed down the road because, oh my gosh, you're rich. And rich doesn't mean you have billions of dollars. Rich means, hey, you might have a couple $100,000 in your Roth IRA.
Well, but think about that though. If you had a couple $100,000 in your IRA that you paid taxes on before you invested it, and suddenly that sunset provision, like we like to call, comes around and the government pulls the rug out and says you got to pay taxes, that's almost double taxation. Or even if they say, well, we're not going to tax you on the principal because you already paid that, but we're going to tax you on what you earned. But that's a big chunk out of your nest egg, because let's face it, most Americans don't have a couple $100,000 in retirement, unfortunately.
Yeah.
You know, a couple $100,000 in retirement for the average family making $51,500 a year, age 65, is all they have in the whole world. And suddenly, what, $60,000 of that is out the door?
Yeah.
30% of it, right?
Yeah.
Isn't that what it comes down to?
Exactly.
With respect to that, if you were to say the difference between the Roth IRA and a traditional IRA, who would be the perfect person that would? I mean, it makes sense to me that everyone would pay the Roth IRA, right? Unless you don't trust the government. Well, wasn't that the common consensus for investing?
Well, the problem with looking at the Roth IRA is typically people look and say, well, if I pay 20%, if I'm in that bracket when I'm pulling the money out, and I'm in the 15% bracket right now, it makes more sense to do the Roth. However, we forget about the time value of money. And that means I would rather have a dollar today versus a dollar tomorrow. So what I'm looking at is saying I would rather have that tax deduction right now and let the time value of money take effect, because that tax deduction of, let's say, $100 today really grows and compounds over time and becomes worth more down the road.
So it's a complicated calculation. This is why you have to call my friends at Wilsey Asset Management. No, they don't sponsor the program, but I had to I had to give you a plug there. I'm going to bring your dad in with you here in just a second for the next break. I'm going to bring him in early because I want you guys both to talk about that. Is this age criteria specific? In other words, if a 40-year-old walked into your office and was talking to your dad versus a millennial talking to you, is that age specific? Whether you'd recommend traditional versus Roth at that point, or is it really situational? Not as much about age.
It is really situational, and one thing we always do is we always look at the numbers. And we'll take a look and say, okay, what is this tax deduction going to be worth down the road? What is this money for? Because if it is truly for retirement, then we believe the traditional IRA will be better. But again, you can't I can't tell you the correct answer without actually looking at the numbers.
See, so I'm going to bring Brent Wilsey in, who is I'm not sure who's smarter these days. Brent's pretty smart, but Chase is catching up to him very quickly. It's going to be the Wilsey program here in a moment, and I'm just going to sit there and let those guys hash it out. Wilsey Asset Management is the name of the company that Chase works for, wilseyassetmanagement.com. I'm Sully. It's the Big Biz Show. BigBizShow.com is our website. You can follow me on Twitter at Sully on Air. We'll see you in a second.